Magnificent Seven. Let's start there. You say there's one stock that is actually frothy and the others are just kind of foamy. Tell us which one's frothy, which ones are foamy, and what's really the difference?
I like Nvidia. I think that that price that it's at right now is very, very, very hard to maintain. You see a PE ratio of 97. It dwarfs all of its trillion-dollar peers. And then when you look at names like Taiwan Semiconductor, which similar space, a company that's been around for a long time that worked closely with Nvidia, and they are just doing so much better on the fundamentals. And even though they've had a great year and a great week this week so far, they're far behind in terms of that price. And so I like Nvidia. I don't think there's a problem with the company. I have been Chicken Little about this space, as any AI maximalist will tell you, for a year now. But I am concerned because what goes up does eventually have to come down.
So that's frothy. You're saying that 97 times forward earnings, PE, I mean, that's frothy. So foamy, give us a sense. Why is foamy okay and frothy is concerning?
I think foamy reflects the broader market. The reality is right now that things are up. We had so much cash sitting on the sidelines last year, waiting for this sort of big crashing downturn that, knock on all of the wood, we have hopefully avoided. And so, we're at a point where people want to put that cash back in. The consumer has shown a resilience beyond anything that any of us expected. And so we're seeing that people are getting back in the market. People are buying again. People are feeling good again. I mean, Bitcoin breached 50,000. And so when that kind of stuff happens, you will see the entire market go up a bit. And so a name going up, a solid name going up while everything else isn't necessarily bad. I think that people right now are really, really looking for innovation. We see names, everything from the Novo Nordisk of the world to the Ubers. We see them go up right now because that's what people want to invest in.
All right, so Sarah, right now we're showing the audience the massive influence of mega cap tech on the market over the last year. The equal weight, we're looking at that only up in the mid-single digits. What does that say to you about the strength of the market and its path going forward? Right now, we're actually showing it to them right now. S&P 500 equal weight up only just about 3.5% over the last year. What does that say to you about this market and the lack of breadth in it and just the direction it's going to take for the rest of this year?
Yeah, I like a wider rally. I like it when everything's doing well and not just one sector, particularly a sector that tends to rely on the future and growth and hope versus reality. But the reality is that there's just a lot of names in that S&P 500 that maybe aren't as relevant anymore, that are legacy names that have been public for a long time or staying public. And if you're a small railroad, that's public, maybe all of a sudden now this isn't going to be the most relevant time for you. So I don't think it's necessarily bad to see that narrowness, but I would like it to broaden out.
All right, we got to get out here, but one last question. Berkshire Hathaway trimming its position in Apple. Again, they're trimming. They still have a large position. Big deal, little deal in your mind?
I think that anything that happens with Apple feels big, but often it's just sort of business as usual. It is a fantastic company that tends to do very well, and sometimes you lock in your gains.